the topic for today, long-term care insurance. Why is it worth considering for our affluent clients? And to answer that question, I don't know how many of you actually did the pre-reading that I kind of sent out to kind of frame the dialogue for today, but it was really, the one handout was really about what are our chances of needing long-term care during our lifetime. So, hopefully none of us has to go through a house fire, but your chance of going through a house fire are 1 in 1,200. Your chance of needing long-term care, 1 in 2. Living to age 65 and then needing long-term care, it's 7 out of 10. So the problem with long-term care is sometimes defining it. Where do you get it? Who provides it? What does long-term care mean to clients? 50% of people will need home health care. 31% will need nursing home care, and 19% will need assisted living. Approximately 87% of claims last for 3 years or less. So it's not forever that you need this care, but it is a substantial amount of time, and due to the high cost, it really drains asset bases, estate values left over for children. One of the most surprising slides that I saw that Al had sent along to me was, who is it that needs the most care, most often, I should say, at least? 77% of long-term care purchasers are married. More women than men purchase long-term care insurance, long-term care needs. 66% of the purchases are women. Women are more likely to go on to a claim. 67% of all long-term claims are for women. And women will statistically be on long-term care longer. 87% of claims are 3 years or less, but women are twice as likely to exceed the 3-year claim, and women are 75 to 80% of nursing home and assisted living residents. To make this more of a women's issue, I feel like we should have my wife here because this will give me more brownie points, but informal unpaid care comprises 70% of care in the U.S. That's provided for by women 75% of the time. Women caregivers, they're 6 times more likely to suffer depression, have double the risk of coronary heart disease, lose an average of $565,000 in wages due to lost work time. At age 75, 74% of men will still have a spouse. 38% of women will still have a spouse. 80% of nursing home and 75% of assisted living residents are women. So when we're having meetings with clients, I know this is happening a lot to me, it's often the wife that will bring up the issue of long-term care. And it's often the husband that shushes it away. And it's sort of an attitude that permeates society, and I think men have this tendency to think, I know I'm generalizing, but men have a tendency to think they're going to be vibrant, and when they stop being vibrant, they're going to die immediately. Women are a little more realistic, and so this care, this idea and concern is really on the minds of women in general, and especially our clients. So Al and I started having this dialogue back in January, and I had a client approach me about long-term care, and what are our options? So I approached Al for a lot of reasons, and I'll introduce Al. Many of you in the room already obviously know Al Gibbons, but many of you who aren't in the room do not know. Al specializes in estate planning and life insurance planning for high net worth individuals, high-level corporate executives, and successful entrepreneurs. He works closely with tax advisors, whether it's the accountant, the attorney, us as trust officers, in designing, implementing sophisticated life insurance, long-term care insurance strategies to help solve our clients' unique protection needs. Many of you know Al as past president of the Philadelphia Estate Planning Council, and I think you won a small award there as a estate planner of something or another, of Lifetime Achievement Award or something like that. So Al is a great friend of Glenn Mead, and he's done, he's helped me out a lot on a lot of client situations. Specifically, finding the right tool for the right client at the right time. So Al's here today really to educate us. After the end of the presentation, you'll get some more information on Al and his on his bio and his practice, which is national in scope. So for those of you in New York or Cleveland or Delaware, New Jersey, we have that all covered, and it doesn't matter where your clients are either. So with that, we've covered the need is real. What we really want to cover today is why are our clients interested, and how can we have a conversation with them? We don't expect anyone to walk away from this presentation being an expert in long-term care insurance. It's complicated, it's confusing, but our clients want to have the conversation. And too many times we push it to the bottom of the list and we walk away from an obvious conversation where we can be providing value and help to our clients. So we want to raise awareness of the need, the possibilities, and how do we have that conversation. So, Al.
Thank you, Dave. It's nice to be here. So let me put your minds at rest right from the beginning. This is going to be a non-technical conversation. We're going to be conceptual. Dave has already pointed out those cheery facts and the needs that our clients have. As an estate planner, as an insurance specialist in life insurance and in long-term care insurance, I deal with wealthy clients, affluent clients, and the real issue that I'd like to sort of frame the context with today is Dave has talked about the need. What's become apparent to me is that these conversations now are happening with clients, especially with clients 20 million of net worth and under. That was unheard of in the past. And it's not because those clients, many of the clients that we deal with, it's not because they need it, it's because they want it. And so, is it worth considering? So if somebody's worth a lot of money, they can self-insure the long-term care need. And in the past, we've often counseled that they do exactly that. But now that the industry has matured, there's been product development, there are alternatives to doing this. More people are considering doing exactly what we're talking about today. So what I want to talk about today is what is long-term care, what are the alternatives, what are the costs, and is there a place for it in our portfolios or in our clients' portfolios, and how should we think about it? So that's really what we're going to do today. For the relationship managers and those who are dealing directly with clients, I think wealth management is a very important, it's a very important title, if it's a title, and a wealth manager. And there's an old Forbes saying, and I'll just sort of substitute wealth manager for what it was. Wealth manager isn't a title, it's something you do. Don't, you're not. Okay, so let's think about that. And wealth management is more than just about investments. It's about tax, it's about protection, it's about philanthropy, and how all those things are connected and correlated. And that's the planning that Dave and Mike James and others bring to the table for your clients, and that's how you can differentiate yourself in the marketplace. So the way that we're presenting this today is really the way I would present it to a client. And we're very fortunate because we deal with people who are smart and they're interested and they're willing to learn. So in advance, I would send out something for them to read to give a little context to conversation so that they know what the issues are, what the questions are, and we can sort of move through some of the things. The presentation today is a presentation I would do with the client. It's intended to be a one-meeting presentation. Now, at the end of that meeting, the client knows whether he or she is interested in perhaps pursuing this topic, whether it's worth considering or not, okay? And if it is, then we do some stuff, and I'll sort of talk about it at the end, but there's no decision that's made because we have to underwrite. And so if the client is interested enough to go through the inconvenience of filling out a little bit of paperwork and taking an insurance physical, we'll do everything else. And then we'll come back with the numbers exactly as they are for that client, and the client can make some decisions at that time. And so I think clients feel very comfortable with that. They don't feel threatened by it. There's no pressure in it. It's, look, this is all about communication. It's all about empowerment. It's about putting clients in a position where they can make the best decisions for themselves and for their families. That's the bottom line here. That's what we try to do. Okay? So, is it worth considering? Well, first of all, let's talk about what long-term care insurance is. It's coverage that provides home health care, nursing home, personal or adult day care for individuals with a chronic condition that needs constant supervision. So long-term care coverage is not provided by private health care and on a very limited basis by Medicare, which most of our clients are not qualifying for or interested in anyway. So generally defined as not being able to perform 2 of 6 activities of daily living. And you'll see this always with long-term care, ADLs. So 2 of 6 or cognitive impairment, Alzheimer's and such. So there are 6 basic ADLs: eating, bathing, dressing, toileting, transferring, walking, and continence. So if 2 of those qualify, we go on. So what's the cost of long-term care? It's expensive. And so these are numbers for, remember, 87% claims are 3 years or less. So if we look at the Philadelphia area, 3-year claim for nursing home private care, we're talking about $350,000 in expenses. So it's about $300 plus a day. And those rates are not going down, okay? Just so we know. So I'm going to talk about traditional long-term care, standalone policies. I'm going to talk about an alternative that became very important in what's called asset-based care, sort of a hybrid long-term care policy. And then I'm going to talk about a hybrid product that has great popularity today. So let's go through these things. And there's no right or wrong answer, but sort of think to yourself, if you were buying long-term care today as we go through this, would it make sense? And would it, which direction would you go? Which would be of most interest to you? So traditional long-term care policies, the client wants the most coverage for the least amount of premium, at least initially. And that's very important. So it may be the least cost initially, but the premium is not guaranteed in traditional long-term standalone policies. And as you may or may not know, those premiums have gone up dramatically in companies. So the client is willing to risk price hikes, which I was just discussing, and it may be for people with income but few assets. The client doesn't care about a death benefit or cost recovery, meaning if the client doesn't care about cost recovery, this is sort of a use it or lose it proposition. It's like your automobile insurance. So if as a male, I'm going to have a vibrant life and die instantly, then I would not have recovered any of my premiums. That's been a big negative in the marketplace. 2 big negatives: the increasing non-guaranteed premium and no cost recovery. And finally, in traditional long-term care policies, the standalone policies, you have this ability to customize it from day one. And so there are a lot of different things you can do. In other policies, you sort of have to manipulate them and do some things with them that can be done, but not as easily as with the long-term care policy. So then, the next policy that really became popular was this asset-based care, sort of a linked benefit. And this client wants a lot of long-term care coverage and features similar to the standalone policy. But this client is looking for cost recovery, and meaning return of premium, okay? And they're fine with a single premium or short pay scenarios. And so in this, and you've probably seen it with some of your clients, put $250,000 in, you sort of buy an annuity with a long-term care linked benefit, and you have offsets, meaning if you use the long-term care benefit, it reduces the annuity benefit at the end, and they're sort of closely linked together. One of the big negatives here is this taking money from the investment pool that you people do so well and giving it to an insurance company in a lump sum. Maybe that's not all that attractive, okay? And then finally, we have life insurance with a long-term care rider. And this is sort of a fascinating product. In the life insurance industry, when I'm doing estate planning with very high net worth clients, those clients don't really need life insurance, but they are buying large amounts of life insurance to sort of considering it sort of as an asset class that blends in with the other things that you're doing and provides diversification of investment. And you'll see why when we show you how that works. But with life insurance, these people have long-term care concerns. They're more concerned with estate enhancement or other life insurance need. They value flexible payment options. So in this policy, you're paying annual premiums. And you're not giving up the use of $250,000 or $300,000 all at once. This product really, you're buying a pot of money, and it's either going to be used for long-term care or as a death benefit to your family. Okay, so either way, this money is going to be used. So one of the things we're going to look at today is if I'm going to pay this premium and I don't need the long-term care benefit, so the whole face amount of the coverage gets paid to the beneficiaries, was it a good investment or should I have been doing something else with my money? So, but they're looking for cost recovery. They want their money back one way or the other, and so we're going to look at the rate of return on death benefit. This benefit will be paid no matter what, either through the long-term care or the legacy benefit or a combination of both. So if I have let's just say I have $1 million life insurance policy and I use $500,000 of that for, let's say I use $400,000 of that for long-term care, then $600,000 is going to go to my children or heirs later, or spouse. Guaranteed premiums on this, they will not increase. Okay, so you have the three things: the standalone policies, that's sort of like the old telephone, and then we have asset-based care, which is sort of like your iPhone 5, and then we have the new one, which is, however that's going to work, we'll see. Okay, so let's go on to the next page here. Okay, so what are the pros and cons of this? And we always want to make sure, one of the things that I do as an advisor when I get called in to deal with your clients is I always like to have stuff in writing so that people always have a record of what we were talking about. And so in traditional long-term care, the pros are the lowest initial cash outlay. And just remember initial, the beginning. At the beginning it's the lowest cash outlay. And there's inflation protection. So we talked about customization. You can put inflation protection on this. You pay for it, of course. But those are the pros, so you can customize. The cons,
okay, so
yes.
what's the inflation protection pertain to? It's rising benefits, or
Yes.
But aren't the premiums rising in these policies as well? Or?
It's built in right from the beginning. So let's say you want a 3% or 4% inflation protection on the policy. They'll price that right at the beginning. It'll be part of the annual premium. Okay? So what are the cons? The big one, and what a lot of people don't like, is use it or lose it. So there's a lot of money being spent, and people don't like the idea that they might go fast and not need it. The cons, the premium cost is not guaranteed. That's huge. We've had some significant price increases in the industry in standalone long-term care policies. So the asset-based solution, the premium cost is guaranteed, so that's good, and you can build inflation protection in from day one. The cons, there's a modest death benefit, and there's a heavy upfront cost. Usually we think about that as a single pay, so you're just transferring money from one pocket over to another and paying for that all at once. The hybrid product, this is the life insurance product with the long-term care rider. So the pros are the premium cost is guaranteed from day one. There's a guaranteed payout, either as long-term care benefit if needed, or as death benefit, legacy benefit for heirs, or a combination of both. And there's a substantial death benefit. What are the cons? Well, no inflation protection. That is sort of true. But when you design one of these contracts, let's say that I'm dealing with a 60-year-old, and we want to, we're concerned about inflation, so we know that our average claim today is around $350,000. We saw that on the slide before. And we know it's usually 3 years or less, 87% chance. Now, how do we deal with that? Well, first of all, if our client wants, we might make it a 4-year benefit, just in case they're one of the 13%, right? So we can do that. We can customize that. Secondly, if I'm dealing with a 60-year-old today, and I think, okay, so let me think about how I might do this. If I were to require long-term care, maybe I'd be about 75 as a guess. So I can figure out 4 years of benefit with $350,000 inflated at 3 or 4%, whatever I choose, and I can construct that today. So it's not 3% annually, but from day one, we've built in some additional protection and actually handled that inflation question later. So let's stop and think about this for a minute. Are we overpaying from day one then if we build a larger policy? Well, we're overpaying on all of them because we're already paying that premium from day one that we build into the others. But I like it better in the hybrid product, the life insurance and the long-term care, because you're going to see that the rate of return on that money is pretty significant. And we'll compare to some of the things that you and your clients are doing in your investment portfolios. So let's take a look at what this costs, and let's just deal with a 60-year-old, okay? Dave, you were asking a question earlier. What are...
Yeah, a lot of times clients are coming at us with when is the right time to buy it. I've had people in their 40s say, is it too early to think about it? I've had people, in their late 70s say, is it too late to purchase it? So when is the right time to be thinking about long-term care insurance, and when should we be buying it?
So I think there are a couple things. There are two tangible assets that our clients need to capitalize on today. And one is age. So when you're 50, and I would say that's when a lot of people are really starting to consider, is probably around age 50 when they start thinking about this. Maybe they have a parent that's going through some things, or now there's enough of this stuff going on that we all start thinking about it. So the premiums are lower at 50 than they are at 55 or 60. So that's a tangible asset that our clients want to capitalize on or might want to consider. The second thing is health. There's a very good chance that our health will not be as good tomorrow as it is today. So there's a very good chance that our health won't be as good at 65 as it is at 55. So we want to capitalize on that, because once we've sort of locked in on that, we have a guaranteed rate forever, depending on the kind of policy that we choose. So I would say people are looking at this 50 to 75. I will tell you, here's a little anomaly. Recently, I was asked to look at some solutions for a 70-year-old female. Interestingly enough, the 70-year-old female was extremely expensive in the traditional long-term care, and could actually buy the hybrid product where you have cost recovery and guaranteed premiums and everything else for virtually the same price. So age is important, but all those things sort of play out. And that's why we don't ask clients to sort of make decisions when we're with them, because they need to process some of this stuff. But furthermore, we have to see what is their health, we have to see what kind of ratings we can get, and we have to see what solution will work best for them.
Tim Fisk has a question. I know you can't see him.
Hey, how are you?
Hi, Tim.
Can you talk about the difference in the underwriting between the asset-based and the hybrid, and because there clearly has to be a difference between the way the insurance companies look at that. And also, I think, maybe to dovetail on what you just said, on the hybrid product, because a lot of our clients have insurance already, how that impacts adding, what it takes, and does the underwriting change when you're trying to simply add a long-term care rider on?
Okay, good questions, Tim. So the first question is the underwriting different for in the hybrid product, the life insurance and long-term care, or between the asset base, which is really an annuity? The underwriting changes, and it depends on how much and what kind of risk you put on the company. And so if we're looking at life insurance, we're looking at mortality risk, and the bigger the face amount of coverage, the more it can cost. In an asset-based product, which is an annuity, there's very little insurance. So you're basically underwriting just for the long-term care piece. The long-term care piece and the life insurance can actually get different ratings. So I had one recently where the life insurance was preferred risk and the long-term care rider was standard, which is not as good. But I'm going to show you some things in a minute about what difference that makes in premium. And then you asked about existing policies. Companies will not add a long-term care rider on an existing policy. So it's new underwriting, it's new policies, and that could be a consideration for people who already have life insurance. It has not been for the clients that I've dealt with.
Can we still do a 1035 exchange from a regular life insurance policy to a hybrid policy?
Yes. And from an estate planning perspective, there are situations where the hybrid policy can be put into an irrevocable life insurance trust. But I don't want to get technical today. Remember, I promised. Okay, so let's go a little further. Okay, so let's look at a 60-year-old on the traditional long-term care, and for the male, the premium is about $4,800, as you can see on the screen, and for the female, about $6,500. So already you're seeing a difference in rating, correct? I mean, it's about 50% higher for the female, and that's because there's greater risk on the female, and we saw some of that in the numbers. Let's look at the asset-based solution, the one-time payment. So for the male, now this is interesting. For the male in this one, it's $250,000, and it's $183,000 for the female, and that's probably related to a residual death benefit. Let's skip over that one and go to the hybrid product. This is a very important point here. In the traditional product, we see the female at a considerably higher premium than the male. In the hybrid product, we see the female considerably less in premium than the male. So you see that the male, 60, for the hybrid product is $14,000 annually. And for the female, it's $11,500. So you say, well, how can that be? Remember, we basically have two issues here. We have mortality, and we have the long-term care need. And if you think about this, when you're looking at a pot of money, which is really a life insurance policy, first of all, the premiums for women in life insurance are considerably less than they are for men, right? So we know that. At least we know that today. I was just at a conference, and there are some morbidity and mortality studies today that females between the ages of 50 and 70, that separation between male and female is narrowing considerably. And they didn't go out into all the reasons, but you can imagine some of the reasons for that: lifestyle, the work environment, and so forth. So some of those things are getting closer. But right now, there's a tremendous advantage for women in the hybrid product. The long-term care rider on a life insurance policy is really an acceleration of that death benefit, isn't it? because if it's never paid, then it's just paid as a death benefit. But if it gets paid, all you've done is you've accelerated the payment, and the companies have to charge for that because now they're paying benefit sooner than they would if somebody died. And so if you look at the cost of the long-term care rider on the life insurance product, the hybrid product, for a male it's $1,462, and for a female it's $1,600. And that's really just an acceleration of that pot of money. That's a very important concept when you think about it. So when you're buying a pot of money, it's going to get paid one way or the other. I want to go back to our original definition of long-term care, and we said that cognitive impairment was one of the qualifications for a benefit, correct? And for long-term, for that benefit to be qualified, you have to have a physician who is going to certify that you have Alzheimer's or whatever this cognitive impairment is. And then the claims people, let's think about traditional standalone long-term care or in the hybrid product. If you think about the claims people, they have to approve it, correct? Well, think about this. If I have a 75-year-old and we have maybe a somewhat weak endorsement by the physician of cognitive impairment, the traditional long-term care carrier has a lot more at stake than the life insurance carrier, because the life insurance carrier knows that it's paying the claim one way or the other. So really all they're doing is accelerating the benefit. This one, if we don't have to pay for it, or if we don't have to pay the claim, I might not want to be as forgiving as this claims person over here. That is really an important point, I think, and we can all relate to that. So what we can see then, as we look overall at the cost coverage examples up there, is the traditional long-term care is the lowest initial outlay on an annual basis, not guaranteed. The asset base, you got to move a pot of money over, and in the hybrid product, it's a larger annual outlay, but you get the money one way or the other. And I think you're going to get it on a very favorable basis. So what does that mean? So this is a female client. This is a client of mine, female, 61, preferred non-tobacco, so a non-smoker. As I recall, I think this also might be standard, so it might be one step lower for the long-term care rider. This is a $750,000 pot of money. The $750,000 death benefit on the life insurance program. The initial premium is $12,668 a year, and it has the long-term care rider. So here's what I want to look at. Is this worth considering? Here has been the problem in long-term care, in the long-term care industry and among clients. The problem has been that the people who really need long-term care can't afford it, or they really are in a situation where they can't afford to use it or lose it. They can't afford that proposition, and that has stopped a tremendous number of people from entering this market. In the affluent markets that we deal in, people who don't necessarily need it can afford it. And by the way, if they can afford it, they just soon transfer the risk to somebody else, especially if it's a pretty good investment. So let's look and see if this is worthy of consideration for the affluent client. And let's just go down to the 10th year. So if my client pays $12,668 a year for 10 years, an annual premium, for a $750,000 pot of money, she has put in about $126,000 total, right? The death benefit is $750,000. The internal rate of return, the investment rate of return, tax-free, is 31%. That's better than what we can usually do in the investment world, correct? So you say, okay, well that's, what are the chances she's going to die in the 10th year? Well, let's look at the 25th year. If my client, who is 61 years old, at 86 dies, and that would be about life expectancy for a female, the rate of return on that pot of money is 6.12% tax-free. Pre-tax equivalent, Dave? 9%? 8.5%? 9?
8.5.
Yeah. Let's say 8.5%. Pretty good. Let's go down to the 35th year. Now my client is 96 years old. She's put in $12,668 a year. There's a $750,000 tax-free benefit to her heirs, and it's 2.75%. Maybe comparable to bond returns, maybe not quite as good as a bond return at 96, but guaranteed and safe. And we may be talking at this stage safety rather than performance. But I would take that chance. Especially since I'm a male living a vibrant life and I'm going to die quick. So this is why, really, people look at this and say, if I have a 60-40 investment portfolio, and I just shaved off a little bit of that every year and diversified my assets and sort of considered this another part of my investment portfolio, will it have made a contribution? I think what you'll find is it's going to reduce the risk ratio in the portfolio and perhaps raise the rate of return. I think it's a pretty compelling story, and my experience is in this marketplace, people like this a lot, and virtually everybody will go to the next step to see if they can get it. And you can buy $750,000, you can buy $1 million, you can buy $500,000. The premiums are pretty proportionate. Wealthy people in estate planning, when they buy insurance, and they sort of think about it as a part of their investment portfolio, they'll buy $10 million, they'll buy $20 million. And I'm not talking about with a long-term care rider, but in general, that's how it works.
Are you seeing clients maybe just the wife purchase, or just the husband, one spouse or the other, or maybe taking a view of this and maybe we'll insure half of the anticipated costs?
Yeah, I think that's a really good question. There are a couple parts to that question. Number one, maybe we'll insure half the cost. Look, we don't know what the total cost is going to be, and we may not, in some cases, want to afford all the costs, but we're willing to hedge our bets a little bit, right? And so we'll buy $500,000. We won't worry about inflation. And maybe we'll buy it on one spouse and not on both. When we talk about both spouses, if you're buying a pot of money, the way I think about it in the affluent market for people who have a lot of money, I would underwrite both. I would ask both the husband and the wife to fill out a preliminary questionnaire and take insurance physicals. And then we'll go out and shop it. And what might we find? We might find that one is insurable on a much more favorable basis than the other. So now it's really only a question of timing in their overall estate, right? So if the wrong person has a long-term, qualifies for long-term care, but the policy's on the other one, they have enough money to fund the long-term care expenses, and basically it gets reimbursed later to the estate when the second person dies, or it's available for the second person. So there are a couple ways to do it, but I think the solution sort of flows from the fact pattern and the underwriting issues. So I don't think there's a pat answer to that. Yes?
Are there policies that are joint that can cover both of them at the
Yes.
same time?
Yes. Well, good question. So in traditional long-term care standalone policies, yes. You can do a joint policy, and you can do a joint policy not for a combined premium of the male premium and the female premium, but you can get a discount when you join the traditional standalone policies together. So that's another thing that you consider. So when we come back to a client and say, look, here are the choices. I've had clients tell me in the first meeting, when we're talking about the standalone long-term care policy, I'm not going to do that. And they already haven't done that for a long period of time because they don't like to use it or lose it, or the non-guaranteed premiums, or some of the experience in the industry today. So I'm not going to do that. So a lot of times clients come out, they say, I like this, I could do this. So that might look good in the interview, but it may not prove to be the best solution after we do the underwriting. So it's very tailored for the specific fact pattern and the underwriting results. Good question. Yes.
Can you do number 3 in a single premium just so you don't have to worry about the lapse?
Yes, you can do a single premium on the hybrid product, but I would probably counsel against that. So here's what I would do. If I had, we've done this with life insurance in the estate planning scenario. And in that situation, there are people who would like to make, for example, at the end of 2012, when people were making $5 million gifts and getting their unified credit out and being able to take advantage of that planning, there were people who wanted to do as part of that single premium life insurance policies. Here's what I suggest. We run the numbers, right? And let's see how it looks. And let's look at internal rates of return. And you can imagine that if you put all your money in and pay a single premium and die the next day, you overpaid for your insurance. And the longer I can stretch out the payments, the better internal rate of return I'm going to have on my investment, on my death benefit. So what I would do in estate planning, it's going to be trust owned. Let's make the gift to the trust, and let's look at if we pay a single premium and how that works, or if we pay an annual premium and invest the balance, pay the annual premium, invest the balance, and you take a conservative rate of return on the investment. Which looks better? And in every case, the clients and advisors have chosen this pattern over here rather than the single premium. But that, yes, it can be done.
What do you tell clients who have an existing traditional policy and they're getting those increases in premiums, but they turn around and say, well, I've been doing this for 10 years. I feel like I'm just throwing it away.
Yeah, geez, nobody likes having thrown all that money down the drain. And there are advantages to the standalone, but I think one company just raised their premiums again on long-term care, and they had a significant increase initially. So I think you have to sort of forget looking back. I mean, look, we've all been in market turndowns and everything else. Pretty soon, you have memory, but you can't look backwards. You still have to look forward, and you have to try to make the best choices. And so you just analyze it. And usually the numbers will speak for themselves. And sometimes people might want to do it, and sometimes they won't. But we can always do the analysis for them without any problem. Okay, good questions. I stopped the presentation right there with the client. I don't do anything more technical than that. And I think this morning in this group, we've already accomplished a lot. We know there are choices. We sort of know what we like or what we don't like. We may have interest, we may not have interest. We may say, yeah, I'm willing to fill out a little bit of paperwork and take an insurance physical to know what my real numbers are going to be. And that's it. That doesn't mean it's over. It means now, again, we're dealing with smart clients, so we'll send out a little follow-up information, but there's still some facts to be determined. There's still the fine print that we need to talk about. But we don't talk about that up front because it's just overwhelming to people. okay? And I don't have to talk about the difference between reimbursement and indemnity if my client doesn't qualify for indemnity. You know, it's premature at this stage, so that the interview ends, and we say, what do we want to do? You want to think about it, give me a call next week, or whatever it is, whatever the client wants to do. But that's an issue that I will talk about with clients. There are issues in the industry between long-term care riders and chronic illness riders. It's only important if a client says to me, well, somebody says chronic illness rider, I should think about that. Chronic illness riders don't really compare to long-term care riders. It's a technical difference, but our clients, especially in the affluent market, because they can afford it, they'll go right for the long-term care rider. They don't care about chronic illness riders. There are tax considerations that we'll talk about and how payments are made. But here are some questions. Now, by the way, I'll give the whole presentation to the client. I just won't go into the part in the second half. And believe me, the clients are appreciative of that, as you are today, I'm sure. Hold the applause. But here are some long-term care questions for people to consider after we've met. How much of a budget is there? Are there assets to make a single pay, or do I prefer lifetime premiums? Is the client willing to risk price increases? Is the client looking for cost recovery? Is it acceptable to the client to pay premiums but never to receive a benefit? Is there an estate enhancement or other life insurance need or want? Will inflation protection be, and so forth? Trust owned or not? That's a technical question that we won't get into today. And with that, I think that's basically it. Yes.
Glenmead's known for our multi-generational advice, so we're finding that we're coming to a point where many of our families are fragmenting. So we don't have $20 million relationships. We have $4, $5 million, or maybe less.
Right.
Is this a consideration for that $4 million family, 55-year-old?
Yes.
How do the tension between, there weren't those, I don't deem them affluent,
right,
but they have the same medical history.
Right. Yeah, so good question. Remember what I said, the people who need long-term care, most of them can't afford it. And the people who could probably self-fund, now that would have some relationship to assets, right? But those who could self-fund would like to transfer the risk if they could. So I think the first question is pretty important. Is there a budget? There's a second issue that I see as an estate planner when I work with your clients, and that is, I've never seen an estate, well, I have actually, but in most cases, in a $4 million estate, I've never seen a $4 million estate where an extra $1 million wouldn't make a difference. Either as a death benefit, a legacy benefit, or to fund long-term care. I've just never seen that. And if they can afford the premium, I would highly recommend it. I think it's more important for them than it is for the $20 million client, because they can get by either way. I think there are some compelling reasons for the $4 million client.
I used to say there was a rule of thumb, and maybe this was a lazy approach to long-term care, but it was for folks who had less than $1 million, go see an elder law attorney about how do you save the family home or property and give away assets. For those who had more than $1 million but less than $5 million, it was really about preserving an asset base to live off of for the surviving spouse, for an inheritance. And for those over $5 million, well, you can probably self-insure. I think today that number for self-insuring is probably on the higher end, more like 7, 8, 10 million, to where you could really be comfortable self-insuring and not impacting your inheritance going to your children. But as Al said, the products out there are worthwhile to be talking about to our clients, maybe up to 20 million, 25 million. But that sweet spot for long-term care has always been somewhere between $1 million and $5 million. And those seem to be the clients who have the most questions about it, because that's probably that's the biggest need. They could spend, if the first spouse If there's two spouses and one gets sick and has a long-term need, long-term care, it really diminishes the pot of money that they're living off of as a couple. So this is
I would say, Dave, that I would have agreed with that, with the breaks the way you had them. But we all know from dealing with clients that they have a number in mind that they need in order to survive. And this goes back really now to the question of the woman, because the woman doesn't want to be left out there at the end and have to change her lifestyle or not have enough money to do what she was going to do. The guys don't think about it very much, So I would
peanut
say,
butter and jelly.
yeah,
is fine.
exactly. Yeah, that's okay. But I would say this is compelling now, under 10 million, and 10 million to 20 million. I would say it's worthy of consideration. So I think that's a really good question.
I think at the very least we should be having the conversation with our clients because someone else is, right? Someone else is bringing this to their attention, and it's a real value add to have a conversation. And I think in the past, we didn't know how to have the conversation. We didn't really know what was going on in the marketplace. So the first step is really having a conversation and then having, Bill, Jan, myself, our team to reach out to, but, someone else like Al to reach out to as well. Don't be afraid of the conversation, I think is my biggest takeaway today. Don't be afraid of the conversation.
Yeah, and I agree with that. None of us wants to have a conversation where we can't go to the next step. And we don't know where to go for the next step. And today, as Dave said, people are asking those questions. And I think it could be something as simple as, and remember what I said about wealth management. It's really about a lot of areas that intersect. It's not just about the investments. And the people who are just talking about investments out there, look, we can all be commoditized. But the more things that you can do for your client and bring value, you're the people, and you have such a great culture here, and you have such great people here that there's so much you can do for your clients, and all you really have to do is say, have you thought about it? Is it an important issue? Why not? And we have resources that can help if you're interested.
I know we're right up against 1 o'clock. Does anybody else have any other questions? Yeah.
So you touched on the joint traditional policy. They don't make a joint hybrid.
Oh, I meant to comment on that. Thanks for asking. No, that is not in the marketplace today. So the question is, joint life or second to die or survivorship life, whatever term you want to use, those policies are not on the market today with long-term care riders. Will they be someday? I would think these companies are trying to figure out a way to do that, but I don't see anything imminent right now. I haven't heard any scuttlebutt about that, but that's a really good question.
We're going to follow up today with an email that has some more information from Al, how to get in contact with Al, another article about long-term care, how do you finance long-term care insurance, and again, I want to say thank you to Al for coming out here and just having the conversation with us. I just want us to not be afraid of this conversation. I think for a long time we've been afraid of the topic, but I think we should embrace it. Our client base is only going to grow in this area, whether it's their parents or themselves that need long-term care. So with that, thank you.
Thanks, Dave.